For years, Bitcoin miners have competed for one thing, and that's power. The cheapest power, the most reliable power, the largest power contracts they could secure. Because in Bitcoin mining, power is everything.
Welcome to Rockdale, Texas, America's new crypto mining hub.
This building that's directly behind me, inside of the buildings, we have this shelving that's 1,000 feet long, 20 feet tall, and there are just miner after miner after miner after miner.
But something changed. The AI boom created a new customer willing to pay for many of those same resources. Today, AI companies aren't just looking for GPUs, they're looking for power. They're looking for land. They're looking for transmission infrastructure. They're looking for locations where massive data centers can actually be built. And many Bitcoin miners are already spent years assembling exactly those assets. And that's why a growing number of mining companies are exploring a transition from AI infrastructure and high performance into HPC, high performance computing. We've already seen this story begin with IREN. Now another company appears to be following a similar path. And that company is KEEL Infrastructure, formerly Bitfarms when it was a Bitcoin mining company. The CEO believes Wall Street is still valuing KEEL like a future Bitcoin miner still. Management believes investors should be paying attention to something else entirely.
It's become obvious that a lot of the earnings didn't actually include anything regarding to their current business models in terms of mining. You're one of probably the OGs in the mining space. You know, you were the chief mining officer before you were CEO. And one of the first to come out as a CEO and state that you're not going to follow that strategy forever, and you're looking to direct your power. Why has it been such a challenge for the public miners? We haven't seen the global hash rate change as much, but the public miners in North America, even what we would probably say 6, 7, 8 months ago, the true blue pure play miners are now literally moving towards HPC. What's been the real reason for that?
Well, I think, the reality is that when you look around at what these public mining companies did was they built up these really small portfolios of large sites. And, at the time, that made a tremendous amount of sense to just have economy of scale at a Bitcoin mining site, simplify your operations, keep it tight, keep it lean, get those economies of scale, and try and, do your energy arbitrage trading. That was the whole framework. When you look around at the traditional data center industry, they've built the complete opposite kind of portfolio. They built very large portfolios of very small sites. And so, when it came into this HPC and AI kind of deluge of demand and this huge wave that's taking place, all of a sudden the desired campus profile for a data center changed materially overnight. The scale had to go up by, many multiples. You had to have way higher energy density. You had to have liquid cooling. You had to have all these different things. And so, it takes a lot of companies a lot of time to figure out the difference in the infrastructure and the difference in the technology and the difference in the engineering and the requirements and everything else. Because with Bitcoin mining, really it's, you just have to make it work, and you want to make it work for the lowest possible cost. And in HPC, it's almost the opposite. And so it's, it's not only you have to make it work, it's you have to make it work and avoid every possible remotely, rare scenario that you can imagine. You've got to put in contingency plans for earthquakes and asteroid strikes and flooding and all these different things you would never consider as a Bitcoin miner. So I think two things really happened. I think you had a huge jump, right? Everything was completely different between building a Bitcoin mine and building an HPC an AI data center. I think it takes a lot of time to build up that level of understanding. And then I think it also takes the traditional industry a lot of time to realize that, the infrastructure and the portfolios that they built are no longer the portfolios that are going to serve the compute needs of the future. And, how do you actually solve that problem? Because I don't think that any company, first initial thought was, let's go reach out to, a Bitcoin mining company because they're really going to be the path forward. I think the reality is that they didn't have the foresight onto what was happening with HPC and AI to go out and procure these large scale sites. And it was only the Bitcoin miners who really had them then turnkey. So there was a lot of learning that had to take place, not only on the technical side of what goes into one of these data centers, but on the business side of how do you work with these companies and how do they work with you? Because they really, I don't think that was their first choice, was to go and work out with a company like this. But they're solutions oriented. Companies like KEEL are solutions oriented. And, this whole opportunity exists because we're creating a lot of value for these potential tenants by solving their problems.
That was Ben Gagnon, CEO of KEEL, talking, by the way. So management believes investors should be paying attention to something else entirely: its power assets, its development sites, and its potential role in the AI infrastructure build-out. So today, I want to answer one question. Is KEEL still a Bitcoin mining company, or is it becoming an AI infrastructure developer? One reason KEEL caught my attention is because of the similarities to IREN. They were both Bitcoin miners. Both spent years securing power infrastructure. Both operate in markets where power availability is becoming increasingly valuable. And both recognize something important. In the AI era, power may be more valuable than Bitcoin mining itself. And now the companies are not identical. IREN is further along in its AI infrastructure journey.
It's an AI cloud that is building infrastructure all over the world, not just the United States, in all these geographies. Dell is its key server partner, right? It wants the NVIDIA GPUs. Couldn't think of a better conversation to have to kind of kick off the day. Dan Roberts, co-founder, co-CEO. You've been a busy guy as well on the M&A side. You've acquired a marketing or creative agency. I mean, basically, why? But there's also this conversation, Caroline and I have it all the time, about the public's perception of what's really happening with data center and how it impacts them.
Yeah, look, brand awareness, we're going global, we're growing our customer base. It's really important to us, but that's a small point in the grand scheme of things. It's all about power and time to compute. And the issue is you can't implement a software update to bring on power.
Right.
The tech industry is very brilliant at going really fast, but you can't code your way to an AI gigawatt of compute, and that's what we're focused on.
In the United States, at least, there is some sort of public backlash, right? In zip codes where data centers are getting built, the public feels the pressure of higher energy prices. What's that like for IREN, and what are you confronting in that respect?
Yeah, 8 years ago when we started this business, we had a differentiated strategy. We never went to metropolitan areas. We went to regional communities where there was an abundance of renewable energy that creates a cost structural advantage over time. And we've reinvigorated local communities across British Columbia, Canada, Texas, and it's an advantage for us because we are located where people want us to do business.
And the market already recognizes part of that story. KEEL appears to be earlier in the transition, but that is exactly why some investors are paying attention, because the biggest gains often happen before the market fully understands the transformation. The question isn't whether KEEL is IREN today. The question is whether KEEL can follow a similar path to where IREN is going. One comment from KEEL CEO Ben Gagnon really stood out to me. He described Pennsylvania and Western Pennsylvania as moving from the industrial revolution to the data center revolution.
People are underwriting that region because historically it's been a huge industrial portion of the United States. There's tremendous amount of the population industrial base there. There's a lot of not necessarily tier 1 metros, but a lot of like tier 2 and tier 3 metros in those regions that also need to be served and are also great markets for companies. So I think that's going to come more and more. And I think part of the Pennsylvania advantage is just that they call it the Keystone State for a reason, right? This was the state that built the country, I mean, it had all the resources that you could possibly imagine that you would need to launch an industrial revolution, with the coal and the iron ore and the steel manufacturing and everything else. Like, I mean, it's actually a very cool story to see that the state of Pennsylvania, which is the heart blood of the Industrial Revolution, it's the coal that produced the steel that made the skyscrapers in New York, that made the battleships that beat the Axis in World War II, that built the railroads across, the country. That steel, that coal is now being moved over into things like nat gas, into things like token factories and AI factories. It's this huge modernization of going from the very beginning of the Industrial Revolution all the way through to the very beginnings of this new AI Industrial Revolution. And it just makes so much sense to me that, the same state, which was the lifeblood and the starting, thrust of the Industrial Revolution, would also be the keystone state of the AI Industrial Revolution.
To reiterate, for decades, Western Pennsylvania was known for steel, manufacturing, and energy such as natural gas or coal. And today, many companies are evaluating the region for data center development. Why? Because it offers several things AI companies need: power infrastructure, industrial land, natural gas resources, and proximity to major East Coast population centers, including Pittsburgh, where you can see Sharon is close to Pittsburgh, and Panther Creek is closer to Philadelphia and New York City. KEEL's Panther Creek and Sharon sites sit directly in the middle of this trend. If Western Pennsylvania becomes a larger AI infrastructure corridor, then those assets could become increasingly more valuable. And one of the biggest challenges facing data center development today isn't the demand, it's the politics. Across the country, communities are becoming increasingly concerned about large data center projects. Residents worry about power consumption. They worry about water usage, noise, environmental impact to the land, and a strain on local infrastructure. What about seeing lights in the middle of the night constantly? And as a result, many projects face delays, legal challenges, or outright cancellation. KEEL's CEO recently noted that a large percentage of announced data center projects are delayed or never even get built. And that's why zoning matters, and approval matters even more.
The big one lately has just been all the headline articles around community pushback, right? It's 50% of data centers in the United States are canceled or delayed, is kind of what the recent headlines have been. And I think back to the Pittsburgh Data Center and Energy Innovation Summit last year. That was, huge fanfare. You have President Trump with the Pennsylvania Governor Shapiro and Senator McCormick and Senator Fetterman and local state senators and state representatives. And you have, heads of Google and Microsoft and AWS there. They announced, I think, 60 gigawatts of data center projects, and I don't believe a single one of them has broken ground, right? So, there's a huge demand for this stuff, but it's, when the megawatts hit the mud, executing is a whole, another battle that you've got to be able to deliver on. And we've done really, really good work across PA. I think the fact that our three sites, Panther, Sharon, and Moses, have all cleared zoning is a testament to that, because that is the piece of the permitting that tends to be the most political, the most community oriented, and the most emotional. That's the part where people stand up in town halls and, state their view on things and state their concerns. And that's that's the area where communities can really get things shut down. The fact that we've cleared at all three sites is, I think, a testament to how we approach development and how we approach stakeholder relations and community engagement. And that's paying a lot of dividends for us in these developments.
Secured zoning approval means one of the most politically sensitive stages of development is already behind them. In other words, KEEL doesn't just have megawatts. It has megawatts that can actually be developed because it's already been approved. Now let's look at what KEEL actually owns. And the first is Panther Creek in Western Pennsylvania. Management describes this as its flagship AI campus. The site currently sits at, and it includes approximately 350 gigawatts of secured power and has the potential for future expansion. And then there's Sharon. At infrastructure development is already underway with substations being built to support future growth, and that has 110 megawatt. Then there's Moses Lake in Washington near Seattle, roughly 2 hours from Seattle. And the site sits near one of the largest cloud and hyperscale ecosystems in North America, where you have Microsoft and Amazon located in Seattle. And management has emphasized that location matters.
I mean, it's location, location, location for the most part. I think a lot of people have really forgotten how important location is in the data center space. This is a real estate industry historically, and location has been a hugely important factor. There's a reason why Data Center Alley exists, right? And why the clustering took place. There is a reason why Quincy, Washington exists and why the clustering took place. Location does matter. And I think when the energy scarcity bottleneck is so tight and the pressures publicly and from investors to go out there and participate in training a new model and being a leader in training these models is so high, people will overlook what was traditionally the more important features around location for solving the energy question. But the reality is that none of these companies are being paid to train their models. Training a model is a cash burning exercise, right? It's an R&D expense that you're using to build a large language model that you can then sell, rent, lease, however you want to refer to it. You can monetize it through inference. And when you look at the leases that have been signed, I think they've largely been signed for training. And if you look at where companies make money, it's on inference. And so the logical, result of that dynamic is that inference should gain tremendous market share over training, because if it doesn't, how can any of these companies make money? And when inference is the largest demand on the data center side, the location will matter again. And so our sites being 2 hours outside of New York or Philadelphia or Pittsburgh and close to Cleveland and close to Montreal and close to Seattle and Portland, those are inference sites. Those are sites that are best suited to serve the market demand that will actually make companies money, and where all of this demand is going to come in the future. So we think we're very well positioned. We think that location has tremendous long-term staying power and value associated with it. And the reality is that being in those locations, it's just frankly it's harder to execute in those locations that are valuable than in a lot of the locations that are less valuable. And so the lessons that we've learned, the competencies that we've developed, the team that we've built around permitting in Pennsylvania and Washington, all these other areas, they're going to be able to go out and repeat the process over and over again. I think the teams that are focused on in Texas, where Texas has had, the easiest path for power, land, and permits in the country, bar none other. If you're taking that team and applying it to Pennsylvania, there's going to be a learning curve. Like, you're going to have to relearn all of these processes. You're probably going to have to hire new people across your permitting team, because a lot of it needs to have local expertise and local knowledge that you wouldn't have from your Texas team. So I think the location is the big one. And then I think the second thing is just kind of process on how we approach development. The big one lately has just been all the headline articles around community pushback, right?
So location matters, power matters, and proximity matters. Together, these sites contribute to a development pipeline totaling approximately 2.2 gigawatts. And that's a meaningful amount of capacity. Recently, KEEL raised approximately $458 million through a convertible note offering, and many investors focused on the potential dilution, but management focused on something different, which is development. And the company now has significant liquidity available to support projects through the coming years. The important question isn't simply why they raised the money. The important question is what they intend to build with it, because large-scale AI infrastructure requires capital, and KEEL appears to be positioning itself for the next phase of development. So at this point, the story becomes very simple. You got the power secured, you got the sites identified and the zoning approved, you got the capital raised. So what's missing is the customers. You need leases, and ultimately the market wants proof, and the proof comes in the form of signed leases. Management has discussed lease execution targets and attracting hyperscale or large AI customers. And if KEEL secures meaningful AI contracts, investors may begin viewing the company differently. That's why this chapter is so important. Everything in the story leads to this moment. So let's go back to where we started. KEEL CEO believes Wall Street is still valuing KEEL like a future Bitcoin miner. And management believes investors should instead focus on secured power, approved development sites, and strategic locations, and AI infrastructure potential.
We look really forward to executing across the three sites that we mentioned, Panther Creek, Sharon, and Moses Lake. Executing across the remaining permits that we need to do over the next couple of months, and lease execution, and ultimately start constructing the site later on this year. So we're really excited about it. We think we've got a tremendous amount of great opportunities to create value for shareholders this year. And we look really forward to executing on this foundation that we've built over the last year and change.
So the bull case is clear. If KEEL converts these assets into long-term AI contracts, the market could eventually view the company very differently. And the bear case is equally clear. Until those contracts arrive, the story remains unproven. So the next 12 months may determine which side wins the argument. And that's why KEEL may be one of the more interesting AI infrastructure stories to watch at the moment. So quick financial for today, June 10th. KEEL Infrastructure is trading at $5.39 today. They have 603 million shares outstanding. What's interesting is analyst ratings give it 7 buy ratings and 1 hold rating. The highest for a 12-month forecast is at $8. The average is at $5.52 and the lowest is at $3. So if you enjoyed this video, hit the like and subscribe button. And if you like access to portfolio updates, research notes, visuals from today's video, and stock watch list, check out the buymeacoffee.com membership link below. Thanks for watching, and we'll see you in the next one.